Thanks, Ashley. Well, a lot's happened since our last webinar, Ash, so it's probably a good time to sit down and have another chat. Today, we're going to be looking at the construction industry and the recent spate of high-profile failures within the construction industry. We'll have a look at some of the causes, what's driving that sort of corporate failure, the flow-on effect, and what people in the industry or those impacted by the turmoil might be able to do about it to manage their own risk. Now, before we get into that though, Ash, there has been a lot going on this month. What sort of news or updates do you have for us?
Yeah, so probably the big thing that I wanted to talk about, and it's really actually only happened in the last sort of 7 days, is the ATO. It's been quite well publicised now, but the ATO issued somewhere in the vicinity of, depending on who you listen to, between 30 and 50,000 warning letters last week.
50,000.
And there were two different types of warning letters set out. One was, and it's the first time that they have ever done this that I know of in sort of between being a tax accountant and in this game in 25 years, they actually have sent out a warning letter for the possibility that you will be issued with a director penalty notice. So effectively what that's done is basically giving directors a heads up that the warning letters that you have a debt, which can that we can actually turn into a director penalty notice and attack you personally.
Yeah.
So that was the first letter that they sent out last week, and then the other letter that they sent out last week was a warning letter too, that they could report you to the credit reporting bureaus. Now, both of these things are not new that they have the ability to do it. What is new is that they're actually doing the warning. And they're giving, and it's in line with what the policy of the ATO has been through this pandemic phase, and that is to give directors a chance to talk to them.
Yeah. So
they pretty much said that if you don't talk to us, if you don't do something, then we have the ability to smash you in these different ways. So given that they'll give them a 4 or 6 week lag time to do for the warning and to do something about it, we anticipate that that's the first step in them actually starting to get aggressive, which is what we've often talked about. So, and it was really interesting looking at the DPN warning letters particularly, is obviously for the first time they've really been able to issue DPNs on GST now.
GST, yeah.
And so the director penalty notice, and for those who aren't aware, and I think most who have listened to us before have heard us talk about DPNs, but it's the ability for the ATO to turn a corporate debt into a personal debt is what a director penalty notice does. Now, if you've got an integrated client account of 500,000 and you've got 200 on PAYG and then 300 on GST, now all of that can be DPNs. And that the GST part only came in the last 2 years. So it's really important for anyone who's got clients who have received these, that they need to, now's your last chance to do something without the legal pressure coming through. And they haven't talked in either of these letters about going down the legal path. They've actually talked about attacking the two things the bid directors often do, is that is trying to protect themselves personally and attack their credit rating, which means that they won't be able to get loans to pay back the ATO.
That's massive, like an adverse report with a credit reporting agency.
Yep.
Effectively shut a business down pretty much overnight.
And it's not, and that's right. It's not just the lending of any new lending. There are a lot of suppliers that have businesses on credit watch, and particularly, we're going to talk about the construction industry shortly. All of those creditors, so many of those creditors have watches on people when there's adverse on transactions. I know Amex, for instance, any mark on your credit file, they'll shut your facilities down the next day. So all of those things will have massive ramifications beyond just the fact that you won't be able to get any future loans for a while. So it is important that people look at it and do something about it now. The other big thing that came out of it, and we've already seen this with a couple of clients who have called us, is making sure that your ASIC addresses are right.
Yeah.
And again, we've spoken about that before, Phil. But if a director's moved house in the last 5 whatever years, if they haven't updated their personal address on the ASIC register, the DPN will go to the old address.
Yep.
And there is plenty of court actions that have happened that says that it's irrelevant. If that's the address on ASIC, that's all the ATO has to do. So you don't want to be one of those directors, or be, most people here are advisors more than they are the end directors. But making sure that you've updated that on behalf of your clients or reminded them to, because otherwise you won't have a sporting chance.
The registered business office usually gets updated by the accountant when they move address, or when they change accountants or whatever, but the residential address often gets overlooked. And that's a really good point. There's the heartbreaking ones are where it's a penalty that the director could have achieved remission of, but it went to an address he lived in or she lived in 3 or 4 years ago, and it expires without them even seeing it. And she becomes a lockdown.
Yeah, and I've got a client, one of the ones that I've received in the last couple of days from a potential client. He's got $500,000 in potential DPNs. And the first thing we did was went and checked the ASIC register, which was wrong. So the official notice, the one that would actually make him personally liable, he wouldn't have got.
I think in our last webinar, Ash, we spoke about the ATO engaging with accountants and taxpayers, and we said there were going to be a lot of phone calls and a lot of letters.
Yep.
Didn't expect 50,000 of them. But
when you think, I guess there's 58 billion outstanding, and that's B for billion that's outstanding. I guess you'd hope it's on more than a couple of people.
Yes.
But 50,000 is a big hit. And, if you think of a normal collection cycle, by the time the election's over, which has often been what I've spoken about as the catalyst for when this will start again, the timing is probably just about as perfect as it can be.
And as you said, the first DPNs that we're going to see that has a GST component in it. Now, while they've had the power to do it for a long time, the ATO during the pandemic didn't really issue very many penalty.
No, well, they got the power at the start of the pandemic, and then they've been nice for 2 years. So
I haven't used it.
No. So the other thing I just say is, for those who do have, as I've said before, we're happy to be a little bit interactive in this, Phil. So if anyone does have any questions as we're floating through this, or comments, please feel free to put it in the chat, or you can virtually put your hand up, and then we'll work out how to do something with that if that happens. I keep an eye on a leash for that stuff. But
electronically, don't do these ones. If your camera's off, it doesn't work.
Yeah, all right. Especially if your camera's off.
All right, thanks, Ashley. Now, there's been a lot of media reports recently about the failure of some major construction companies, and what we're talking about is Probuild, and in Queensland, a large construction company called Condev. Both failed. Now, there's talks of other companies facing similar issues out in the industry now.
Yeah.
What's the root cause of all that, Ashley? Where's that all? What's driving it? Where's it mainly coming from?
Look, construction's always been, in my opinion, a really high risk game, and it is. Of all industries, it's probably got the highest insolvency rates. And that's been sort of, common for the last 10 or 15 years anyway. But when and a lot of that's been paired around the fact that we've got this fixed price contract. You've got banks, developers, builders, subcontractors, everyone's wanting certainty, and fixed price contracts are obviously a way of trying to create some certainty in your income. And the costs, obviously, but with everything that's been flowing now with supply issues and supply pricing and all the rest of it, there's been some significant upward pressure on costs on developments, and then that's therefore put a lot of pressure under the construction industry, because they're actually trying to do jobs on, in some cases at major losses, and certainly Probuild showed a bit of that. Hutchinson Builders came out trying to present themselves as someone who's not going to fall down, by saying that they had a turnover of $3 billion in the last year and their profit was 30 million. For me, I wouldn't be excited about that. 30 million, that's a 1%. That's a 1% return on your revenue.
And margins are tight. In construction, margins are just tight for starters.
30 million is not, over everything that they're building, there wouldn't take much for that to disappear. So, but they're trying to say that they're strong by having a 1% profit margin. So, it's a lot of it's just that everything's being squeezed everywhere in construction.
And I think construction companies have found themselves in a position where a lot of the risk is forced onto them. So the developer has a fixed price contract. The bank relies on that fixed price contract when it provides funding for various things. So all the risk sort of sits with the builder. The developer's fine, the bank's fine. But it's been that way for a long time, Ash. Like there's been fixed price building contracts for this stuff as long as I've been in the game. And builders know that. So what's so different about the current situation?
I think obviously, I mean, you put it down to the words of COVID, but there's a lot more to it than just the COVID thing. I mean, the building industry has been changing over a number of years now. There's also have 400. Well, something positive. 400 million in the bank's good.
Talking about Hutchinson's, and the comment was made in chat that they do have 400 million in cash reserves, and that's great. And we don't mean to disparage Hutchinson's in any way. We're just using their public announcement as an example of even a company with 400 million in the bank is running at a very tight margin. It's running effectively at a 1% margin. So that's really the point. The only point we're talking about.
Certainly there's no comments coming out of this webinar saying that they're likely to go down or anything like that.
But if they're running at 1%, there's a lot of builders out there that don't have 400 million in the bank that are probably running at something similar.
That's right. Yeah. So, and I think there's been a degree of centralisation when you look at builders lately. There's certainly been, the bigger ones are getting bigger and the smaller ones are being squeezed out of the market because they don't have the extra cash reserves, the smaller ones, to be able to do these things. But we're also seeing the bigger builders are moving into smaller projects because early part of the pandemic and before the pandemic, they were actually had more staff and they could use them better. Now there's a staffing issue, which is a whole new issue that we need to do. The other big one is cost escalations. I mean, you pretty much can't pick up a building material that hasn't gone up in price in the last sort of 12 months. And then you add to all of that, all the fuel costs that are now kicking in and the impacts of that, and transport costs, which are for driving up the supply costs as well. So all of those are creating some real significant issues in the cost to complete for projects. And you're being caught on a fixed price contract where you thought you might have had 25% margin, and now that margin's slowly being eaten up. The other big thing is, well, what I've seen in the last sort of 3 to 5 years in the building game is that they're almost the game around rectifications. As most people know, that there's always a retention phase with buildings. So there's often 10-15% of money of the full price contract, which is held in retentions for 12 months. So the profit of the job is held at, for 12 or 18 months into before you get paid it. But now we're seeing a lot of the really big builders are putting teams and armies of lawyers together internally to find loopholes, which then mean they're not paying the subcontractors. Now, that's not everyone. I want to be really clear. It's not everyone. And I'm not going to mention the ones that are really good at it and the ones that are really bad at it. But Condev was an example of someone who was really good at it. They really work with their subcontractors, and when they went into liquidation, they had a lot of positive things said about them by their suppliers.
Yeah, they did.
But it's not everyone, and that's almost the unusual rather than the norm.
The other thing when you're looking at construction companies effectively is that time is money. So if you've got COVID lockdowns that delay your projects, or you have unavailability of staff, either through competitive pressures in the industry or the great resignation, or, different locations where you can't source tradespeople or contractors, there's still costs associated if there's no work getting done on the site. Yep. So effectively time is money. So as well as the rising costs, you've also had these delays in projects.
Yes.
I just want to talk through a few of those things, Ash. And we've spoken about supply chain issues in previous webinars.
Yep.
It's difficult to get materials and supplies. Even when you can get them, the price is going through the roof. It's costing a lot more than it ever did before.
Yep.
We also spoke about labour issues with resignations and difficulty retaining staff.
Yep.
What are you hearing there now since we last spoke about these things? What's news in the industry?
Yeah, look, well, I think, a colleague of mine was talking to one of the builders who they've got an expectation that there's going to be a 25% increase in supplies from April on. So they're still expecting further increases in supply costs and supply chain issues. We're also hearing that a lot of tradesmen and subcontractors are getting very, very picky about where they're going to go now.
Yeah.
Because of the labour shortages, they're actually putting their own upward pressure on builders and developers, because they can pick where they want to go because they are in high demand. They're not wanting to travel as much. So you used to have people flying, going everywhere for a job. Now they don't need to. So the cost of fuel and all the rest of it certainly has an impact.
Yep.
And the ability that they can control things. And projects. The other big thing is that there's been a lot of project delays, which are just eating into a lot of costs, and it's creating, some of the breach of contract issues that that are starting to come into play as well now.
So a construction company's got a fixed price contract, but the cost of everything's going up, and that puts them in a real difficult position just to start with. I've heard some construction companies are sort of delaying the start of projects, hoping that things stabilise or that costs ease off. What do you see as some of the issues with that sort of strategy, and let's just put things on hold and not start that new build?
Yeah, well, one of the big things is we still don't know whether the things are going to go up further. So if you try and delay a project, you could end up with even a higher cost base to deal with in 3 or 6 months' time if you try and delay it through all of that. And I think as unfortunate as it is for those in Queensland and northern New South Wales, the flooding is going to create a push of products into that area, which will mean that other areas will have more of an issue getting hold of supply, which will then raise the prices in those other regions as well. So you'll have a regional change in pricing that will have an impact as well.
Yeah.
But, if you delay, you then start running into the issues of breach of contracts and then more legal cases starting up.
Yep.
And, a lot of contracts have got start dates and end dates. And if you miss those, then there's liquidated damage costs. If you do start, then they'll find reasons under the rectification issues to then, to take some of what would otherwise be the retention money. So you could get 90% down the project, and all of a sudden they've got a game being played to keep the other 10% of the retention monies and not hand them out. The other big thing, if you look at the smaller level in the units and houses, is a lot of people who have paid to build houses aren't going to get them. They could be 12 months in waiting for their contract, delay after delay, and then all of a sudden they just walk away and say, no, we're not building your house, and then you've got to start again. And those mum and dads have got the holding costs on the block of land that they might have had, or they might have had the construction loan and they're paying some fees on that while they're waiting for it to start. So, there'll be cost burdens that you don't expect that will come from delays in contract starts.
So if you run out your sunset clause, they're commonly referred to as sunset clauses. If it's not built by this certain date, if it's not finished, that contract lapses. And for some people, they would have signed a contract, a couple of years ago, maybe, when property prices were what they were a couple of years ago. Now, if they can't settle that contract, if that property doesn't get built and the contract gets voided, they could be facing a significantly higher price to obtain the same property.
Absolutely.
From somewhere else. And as you say, legal disputes, people getting sued left, right and centre. I think developers they're always keen to let contracts expire in a rising property market and much less keen in a falling property market. They'd rather get
and I'm not even going to pretend to know what property is going to do over the next 12 or 18 months.
Yeah, I think it's going to be varied. It's going to depend on where you're watching this webinar from, how your property goes. So we have seen some very high profile construction failures recently, corporate entities, and they've allegedly been or reportedly been caused by the issues we've spoken about today. I think the effect of these corporate failures is a bit like an iceberg. There's a bit above the water that you can see, and there's a much bigger bit under the water that you can't see.
Yeah.
So, Ash, if you could maybe just talk us through the immediate effect of some of these corporate failures, and then a little bit about more the unseen effect or the longer term effect. What do you see straight up with these things?
Yeah, well, I think if you look at, we're picking on Probuild because a lot of the information's out in the press, but you could pick pretty much a number of the different ones. But Probuild's got at least 2,300 creditors that have been identified, and the administrator has said that there's more, but they don't know exactly who they are yet. There was over $311 million in trade liabilities alone.
Yeah, that's not finance, that's just trades.
That's just the trade finance stuff. Yeah, there's 768 staff that have been impacted by it. Yeah. Now, some of those, we're hearing are going to be picked up by the new, some of the people who are buying some of the contracts, but there'll be a lot that will need to be moved on. And in some locations, there's hundreds, if not thousands, of tradesmen that have lost their jobs. And I know in the Queensland Probuild, they've got some significant issues. Some of the Melbourne projects, not so much. They have people interested in buying them. And, so that's the immediate effect. But what happens in behind that, I guess, is the ripple effect is it's not so much, like if you're a creditor of Probuild, you know that you've got a problem. If you've got insurance on that, you've already been paid out on it. And a number of the insurance companies already talked about the fact that they paid out some very large sums of money on Probuild. If you didn't have insurance, then you know that you're moving on. But the problem is the ripple effect, and it's that moving on. So I personally may not have been contracted to Probuild, but I was contracted to one of these creditors of Probuild. Now that creditor can't pay me, so then the ripple effect down the line comes into play. And that's probably more what we're worried about, particularly in the market that we focus on as a firm here, is it's not the Probuilds that we deal with directly, but it's the subcontractors, it's the 2,300 creditors that run off it, and then the 5,000 to 10,000 creditors that run off those 2.5. That's where we see the real issue, and that comes back to the mum and dads that will probably could lose their houses, can lose their own livelihoods because of it, but they never worked for Probuild.
They may not have even known that they had any sort of exposure to Probuild, because if you're owed a lot of money by somebody that Probuild owes a lot of money, you could have a problem, even though you never did business with them.
They talk about the marriage debt contagion through marriage, but it's you can have debt contagion through the flow-on effect and the ripple effect of business as well.
Absolutely. So a business could be thrice removed from Probuild and still get hit with that downstream impact of that failure.
Yep.
So have there been any immediate examples of a failure directly linked to the collapse of Probuild, Ash?
Yeah, well, this was one of the 2,300, so they were original link, and that was High-Tech Glazing, which came out, I think it was about three weeks ago now, and said that they had to go into liquidation because of losses on the back of Probuild.
Yep.
And they had another 137 workers that they had to let go. They owed $3.5 million to creditors themselves.
Right.
So it's just that flow-on effect. Probuild has got thousands of these. I hope it's not that bad. And again, I'm not trying to be. I'm not actually trying to be negative at all. I'm just trying to highlight a point so that then we can all look at the ones that we need to protect, and we'll talk about how we protect them. But I'm not trying to be negative about it. It's just it's highlighting the risks.
You don't want to be negative about it, but you can't stick your head in the sand about it either.
No, that's it.
the way it is. So High Tech were working on a big development, a big commercial development for Probuild in Queensland, up in Brisbane. So let's talk about some of those things that might not be so visible as a ripple effect in corporate failures, Ash. What sort of things do you think might become an issue in the future?
Well, one of the big ones that we're already seeing the impact is insurance. Insurance in all parts. The building industry seems to need insurances for everything. I know that in the debtor insurance, one of the major debtor insurers did put out that it was one of their biggest payouts they've had in the last 10 years. So they will have to compensate that with some price rises, or more than likely have some price rises in debtor insurance.
You got there's a very limited number of suppliers in that area too, Ash. It's not everybody does debtor insurance. So you've got a centralised industry that's been hit with a bit of a shock. So there's clearly a potential there for price rises.
Yes, yeah. And I think the other thing is that what you'll find is that people are going to get more nervous. So they're going to want more insurance, higher insurance covers, and the insurers are going to be less likely to want to cover. Yeah. So even your ability to get the insurance needed to do new builds is going to be at risk. I know one of the other issues that often happens is with if you're a company that uses debtor factoring, for instance, you might go and get debtor factoring to try and smooth out your cash flow, but they require debtor insurance on all of the debtors in your book. And if one of those doesn't qualify because everyone's getting more nervous, or going back to what we said at the start, all of a sudden they get a credit mark on their name from the ATO, then they're not going to be able to get the money from their debtor finance facility for that individual creditor. So you'll have all these flow-on effects just in the insurance world alone.
And if you're a construction company out there now, it mightn't be a great time to renegotiating your insurance premiums for the coming year either.
Get them locked away now.
Get them locked away now. And the banks are going to require the insurance for the construction. The developer's going to require it, and could be an issue. So insurance could be a bit of a looming issue in a number of different areas around debtors, as well as around the construction cycle. What else do you think might be measurable outcome from this sort of thing, Ash?
Well, I think it's there's the banks, I think, are going to become more risk adverse. They're going to want potentially higher sales than they already want. They're going to want they're still going to want fixed price contracts, but developers and builders may not be willing to give them. If the banks are going to put a lot of pressure on. In the construction industry, it's quite interesting. The big banks, the big four, will often only lend to about 40 or 50% on big projects, and then they top up with the second tier lenders coming in with second mortgages on the properties on the back end. Those second tier lenders are going to be very, very nervous, particularly if we start seeing a drop in the prices. So you're going to see a lot of contracts that may not actually, a lot of developments that may not actually be able to get the finance to complete or to even start.
Or that mix changes between the major bank and the second tier, or even the mezzanine lender, where the effective interest rate is a lot higher because the bank reduces that low rate stuff, and you've got to replace it with your second mortgage stuff. So
and again, coming back to the other big thing, I think is trade creditors. You're going to, if you're not keeping your company squeaky clean, and as I say, with all this credit bureau and credit scoring now, marks on your name will mean that you're not going to get, you're going to have accounts closed on you. And we're seeing that more and more, that people, particularly in the construction game, are getting more active about managing their credit risk. If you need to start going to cash on delivery of goods because you've been caught out and you can't pay your bills on time, and that just creates even bigger problems as well. So it's quite far-reaching, and a little bit unknown, I guess, is the other thing. Is that everywhere you turn a tentacle that goes through all of this, it flows on quite deeply through the process.
So this has the potential to, again, force further changes in the actual construction industry.
Yep.
What do you think might happen in construction?
Well, I think one of the things that's already happened is that there is a bit of a void on developers, like even losing the two big ones that are noted at the moment. That's quite a void in the market now. There is a Sydney builder that's talking about buying some of the Probuild projects, and I believe that that's likely to become finalised in the next week or two, from what we're hearing. Condev's now got to go out. All the developers that had the projects with Condev now will have to go out and find new builders that want to do that type of work. So there is a real void, which is an opportunity. For someone with 400 million in the bank, that's an opportunity that you can come in and take some stuff. Sure. And by all of those contracts effectively have been null and voided by the liquidations. So now there needs to be some renegotiation, which could potentially help. But I'm not sure that the developers are that excited about having to renegotiate that sort of thing, but they want to get it done. So there will be a rationalisation. If you look in the court list like I do, well, I would say, normally construction's about 25-30% of insolvency. At the moment, and this is anecdotal, I haven't actually done the maths on this, but I would actually put it more at 70% of the companies that are in the court lists for liquidations and wind-ups or have been shut down. I would put it more at 60 to 70% at the moment. They're dropping like flies. And that you just have this continued ripple effect as it flies through.
I feel sorry for the people that ran Condev, because they went to their developers and asked them for additional money. They wanted another 25 million to be able to finish their projects.
Yep.
I know one of those developers personally. I can't imagine having that conversation with him. I know the guy, mate. That's just not going to work. So that's unfortunate.
Yeah.
So lots of issues, Ash, and we don't want to be negative. So let's talk about a few more proactive things.
Yep.
What are we seeing construction firms starting to do now to manage some of these risks, Ash?
Yeah, so one of the big things that we're seeing, and you mentioned that Condev went out to their developers to try and get some support. Yeah. I think some are doing that earlier now, and they're actually, it's more of a partnership than it is this you're a supplier on the client. So there is a little bit more of that going on that we're seeing. The other big thing that's starting to flow through are contracts with price reviews in them. So they're setting high-low margin targets for certain suppliers. Mm-hmm. So, for instance, it might be your timber, your steel, your concrete. There might be a high-low price. If it goes outside of that, then there is a review option that's been made available for everyone to come back to the table. Early days on those yet, because if you do need to flag that it needs to go up, how those negotiations then pan out is another thing. But I think from a protection point of view, putting those type of things in place are good. Yep. But for the guys listening today and the clients that they have, probably one of the big things that I think is really, really important is that they get them to really understand that they're tight on their own creditors. There's and they're on their customers. They're actually putting credit checks in, and they've got some of those things, those sophisticated things that you normally only expect for the really big builders, that we're doing it at the smaller level, so that you're getting that early sign of protection, and you can get some control over it. The high-low contracts, we're mainly seeing that in residential, in the smaller end of the market at the moment. Yep. But that will feed through, because of course the big end of the market, some of these contracts are 3, 5, 8 years in the process. So that'll take some time for that to flow through. And I guess some of the bigger ones are also hoping that the highs and lows will actually flatten out over the course of things. They're the main things, I think, for construction industry. I think it's really just cautionary tale now. You really want, look at your creditors, look at your debtors, don't let them flow. Stop working when someone's not paying you. I can't tell you the amount of times I've seen clients come into our office who they've missed 2 or 3 tranches of payments because of reasons, but the builder or the developer has convinced them to keep going, because then I'll be able to give you the money if you get to this next stage.
Checks in the mail.
Checks in the mail stuff. So, and the smaller guys are paying their staff, they're buying materials, and then they're being left in a bigger and bigger hole.
All right. So for some companies in the construction industry or related to it in some way, what sort of things should business owners there be looking at doing now? And really, we're talking probably about the clients of some of the people that are watching our webinar today.
Yeah, look, it's very much I guess that Boy Scout mentality of being prepared. Hope for the best, prepare for the worst. And that's, we've often talked, Phil, about the plan Bs and having a look. Business owners are the most optimistic humans on the planet, and they always believe it's going to be better tomorrow. But knowing that you've got a backstop and a protection in place allows you to have that fight a little bit safer rather than running completely in the breeze. For builders really trying to put new contracts in place, I think is critical. If you can have the price review function negotiated in, that would be great. You talk to the right type of lawyers who know how to put that sort of thing in place.
Yep.
But don't always just be subjected to someone else's contract. It might be that you need to write the contract to make sure it suits you more than it suits the other way around. There's having some trade, looking at splitting up your trading entity from your asset holding entities, those type of protections, so that if you get caught at the trading entity end, your assets aren't as much at risk as they were.
Okay. All right, now this is a bit I've been looking forward to. This is the bit where I'm going to start firing rapid fire questions at you, because we're going to talk about a few things that we've spoken about before. So we just want to run through these quickly. And if anyone has any observations or questions about it, put it in chat or give us a ring later. So here we go, Ash, you ready? I'm going to fire topics at you.
Do my best.
You're going to explain them to me and tell me what you should do about them. All right, here we go.
Right.
Debtor-creditor relationships within a business group.
Right. So I think they're critical about reviewing your Division 7As, looking at your relationships between multiple entities in your group. So if there is money that's been going from, talking to a client this morning, New South Wales to their Queensland business, they've got different companies for both. Balance those out. You have a review of them, repay them, put loan agreements in place, have all of the protections in ready now so that you're not having to create them later. And look to settle them out if you can.
Yep.
Keep the connections between businesses uncoupled if you can.
Because if something goes wrong, the liquidator is going to want those loans back.
That's
all
it.
Right.
Yeah.
ATO lodgements. Should I lodge my tax?
This one is the most ad nauseum I reckon I've ever talked about, is that make sure you do lodge. Paying is a separate issue. Lodging is critical at the moment. If you lodge all of your business activity statements, installment statements on time, it's critical that you are actually lodging, so that you don't end up with the issue that you've got the notices coming at you later, or DPNs and stuff like that for non-lodgement. So, if a DPN is issued on a director, they only have 21 days to actually make that, to rectify it, either by paying it or putting it in liquidation. If you lodge, you've got a better sporting chance.
Sure. All right. Ownership of business assets, and you alluded to this already. So,
yeah, big believer in the asset holding company. I know that runs in and out of flavour over each decade that my grey hair tells me that I've been around.
You and me both, mate.
I think asset holding entities, particularly now with the PPSR, where you can put PBS leases in place and that sort of thing, I think it's critical that you do have an asset holding entity to give yourself some extra protection. If you don't have it, there is a process to put it in place. And if you do have it, make sure that it's actually being worked properly.
Yes.
And that there are invoicing and there are payments occurring between the two. And like we often see, the trading entity is the one with all the money flowing through it. So then they go and get a new lease on a new piece of equipment that's in the trading entity. That has to happen sometimes. But once it's been paid out, do a transaction to move it into the asset holding entity. So that's a big one for me at the moment.
But of course, when owners buy things, they always discuss it with their accountant first and do it the right way.
Absolutely. Yes, yes.
Big one here, Ash, personal guarantees. I know it's one of our favourites.
Yeah, a big thing for me is personal guarantee register. I think if you're doing it now when you're not under pressure, it's critical that you get your clients to look at it, put together a list of who they have personal guarantees to, whether they have caveatable interests, whether they have equitable interests, what type of security each of those personal guarantees have, and what do they have security over. And then you can look at what you need to do to protect against that if you have the ability to do it.
Okay.
Now, if they're looking at the personal assets, are they in the right spots? Do they need to be moved? Do we need to do things there?
Yeah, so things like one director, right? Not husband and wife as director. All right, Ash. Now, we'll come back to some of that in a minute, but I just wanted to talk about something that you and I see all the time, and that's business owners lending money to their businesses and even increasing the debt that they have on personal assets, like the family home, borrowing money against the family home so they can lend it to the company. And I think we are going to see a bit of that in the construction industry, where a lot of firms are just going to try to ride out the storm and maybe throw a little bit more money at it. If you had a business owner or a related party, like, I don't know, mum, if mum was going to lend the company some money, what advice would you have for her?
But anyone who's putting money into their company, whether it's mum or yourself or whoever, you're acting like a bank by providing money. So take the security that the bank would. So have a general security agreement, have a PPSA, mortgage loans in place, have all of the security and more than you probably would normally give to a bank. Take all the security you can for those loans, because then if things go bad, you're the first one who can get paid back. Again, you and I have spoken about this before. The amount of times I've had someone sitting across the boardroom table going, but I put the money in, why can't I take it out? Well, if you have security, you can take it out.
The even better one is when you say, do you owe the company any money? They go, no, it owes me money. And actually the other way around. Valid point, mate. So get that security interest in there and be a bank. Act like a bank.
Yep.
What sort of things does a bank want? Well, a bank wants personal guarantee, doesn't it?
Yep. So
if I was borrowing money from a family member, I'd be quite happy to give them a personal guarantee.
Yep.
And I'd be quite happy for them to have a caveatable interest over property in my name. If anyone's going to have a caveat over my property, I'd rather it be my mum than be a trade creditor.
In most cases, some mums can be a bit harsh.
You were probably a naughty boy, Ashley. So the normal things, have your security set up, have a good think about it, what interest rate you're going to charge, what's your trigger for default.
Yep.
And make sure you're not throwing good money after bad. That chucking a bit more money at it's actually going to get you through.
Yep.
But if anyone has a client that ever is thinking about lending money to a trading entity, they really need to secure it. To me, it's just a not negotiable.
Absolutely. Yeah.
All right, mate, let's move on because we've been going on a while today.
We have.
Yeah. So the company director or the business owner's personal position, we've spoken about them being exposed under personal guarantees.
Yep.
Just quickly, what can they do to protect those personal assets if something goes wrong?
Yeah, well, again, nothing new that we talked about, but it's one of those reminder things, and it is that if you've got equity in personal assets, then you're the director at risk. There is options to sell that equity to a non-risk party. So whether that be a spouse, another entity, there are options that we can actually go through a normal commercial transaction to purchase the equity from the risk, from the director who's under risk.
Yep.
And get that protected equity into a state that is not available to personal guarantee creditors. So I think it's that's an important one. It's that the whole asset protection thing. I know that you and I, Phil, are working on a client at the moment who's really a very strong business. Good money in the bank.
Oh yeah.
But there's plenty of risk in the industry that they're in. So working on a project to actually just really mitigate some of those risks that were there.
Yep.
A couple of mistakes that were made. So yeah, that they were, you know, the wife was had the house in their name, so they had the right thing there, but the husband was still paying the mortgage.
Yeah.
So yeah, so you create an equitable interest that you thought you were protected from.
Mm.
So we're cleaning up all of that just as an insurance policy in case things go bad. Now, like insurance, you know, in some ways you almost want to use insurance, but in this case you don't. But if it's there and it's safe and it's done right, then it's protected for good.
All right. So actually, let's be frank, mate. A lot of business owners should do this anyway. It's just that the spotlight's on the construction industry at the moment. Would you agree?
Yeah. And look, we've spotlighted construction today because it was a good way of explaining something that was in the paper. But to be honest, this risk is across all industries. You know, we're talking to financial services companies, professional services companies, manufacturing, logistics. All people are seeing the same thing. It's just that the front page of the news in the last couple of weeks has been these big builders. So we thought we'd focus on it from that point of view here today. Yeah. But all of these principles apply to any type of business structure, and the ripple effects I think you're going to see across all types of industries. So I think as much as we're talking construction today, it really is a much broader risk and issue that everyone needs to be considering across all types of business.
And I'll just say very quickly that for a business owner, if they deal with their personal assets and they sell the equity in those assets to a third party for a fair price, and it's all done legally, it actually reduces the risk of them having to go bankrupt because they become not worth chasing.
And just as importantly, lets them sleep at night, knowing that they're not going to lose everything. Yeah.
All right, that's all I had for you today. Ashley, you did very well in our rapid fire section, mate. Congratulations.
Thank you, buddy. Thank you. All right, so we will open up now. I know that there is a comment from Kim, NCF2. I suspect he might have been typing on another part of the computer about something else, so I'm not sure if that's a code that I meant to know. If anyone does have any questions, please either put your hand up or type it into the text message into the chat box, and we can talk through any questions that you may have. But I'll, in wrapping up, again, I thank you. Well, the polls come up. I thank you all again for attending and coming along. We really appreciate that you take time out of your day to listen to the two of us have a bit of a rant and have a bit of a discussion. And I do am grateful, and I hope that you get something out of it. We do have a question here. What sort of security should a person giving a loan to a company ask for?
I'll do this one, Ash.
Right.
So firstly, you need a written loan agreement. Secondly, you need what's referred to as a general security agreement. It's also called an ALLPAP. ALLPAP stands for All Present and After Acquired Property. And that's registered on the Personal Property Security Register, PPSR, and it's registered as a charge over the company. Now, if the company had a major asset that the lender was financing, like the acquisition of a piece of equipment, they can also take a specific security interest over that piece of equipment. But at a minimum, an ALLPAP and a written lending agreement. We'd also recommend that the company director, if they're borrowing from a related party, should offer a personal guarantee and the right to take a caveat over any property in that guarantor's name. Now, that's optional. I wouldn't do it with somebody that I was arm's length from me, right? I wouldn't do it with just a mate, but I might do it with a family member, where I'd rather have my family member taken care of, and I've given them my personal guarantee, and I've given them the right to take an interest over my property.
And Andrew, I know that you could have a chat to Terry, and he can give you a lot more detail on that as well. But thank you for participating, Andrew. It's very nice of you to jump in. All right,
I gave myself a 10 on that survey, Ash. I don't know about you, but when I gave myself a 10 on that survey.
Look, there's always going to be people who like and dislike, but it is nice to see that most people appreciate it. So Look, we will wrap up there. There doesn't seem to be too many other questions. So great to have you all along. We look forward to seeing you all again next month. I will say for those who like the in-person seminars, if you haven't seen them already, the invites have gone out for some in some of our states. We're attempting to run the gauntlet and do it in person, Phil.
Yep.
But we'll also our webinar series will continue as it does in the first Thursday of the month. So keep an eye out for our next one. We'll try and keep it fun and engaging and entertaining. So thank you all. Appreciate everyone joining us. Good on you, Nicole. All right, everybody, have a wonderful day. Thank you again, and we'll see you soon.
Thanks, everyone.
Cheers. Thanks, Phil.